I'm with the Institute for Energy Economics and Financial Analysis. My name is Kathy Hippel, and I teach corporate finance to a group of MBA students who are studying MBA through a sustainability lens. And at the Institute for Financial Analysis, we are all passionate about the environment and passionate about social issues affecting people who live on Earth. But we also understand that many decision makers and stakeholders are motivated by financial analysis and economic understanding. So we produce reports. We're a global institute, and we produce reports in the service of our partners who are often grassroots organizations on the ground working on environmental and social issues. So when we have worked to fight a coal plant, for example, we often go before a public service commission and we make the financial case that coal is not economic. So it is not that we don't care about the environment, but we come at things through an economic and financial lens. So I'd like to discuss today fracking, that it has been a production boom, we can all agree, but it has been a financial bust. And this is something that is not well understood because people have been focused on how much natural gas and how much oil is being produced by fracking. But financially, it has not yet been a proven business model by any means. And this has gone on now for nearly a decade. And then I'm going to talk a little about visioning that what is the alternative. So I work with a group of students at Bard's College, the MBA in Sustainability, and we've done a couple of case studies, one on solar and one on wind in 2 different states, and looked at job creation. We have looked at tax revenue increases. So there is an alternative vision out there. So with no further ado, what I'd like to just restate is that fracking has had a huge impact on U.S. energy markets. It has created a boom in natural gas production, a boom in oil production. But fracking, as I mentioned, has been a financial bust. And the economic development created by fracking has been overstated. The jobs are largely transitory jobs done by people in other states, and they're temporary. Tax revenue, when sometimes fracking companies come in and promise that there will be tax revenue increases, they have overestimated those by a huge factor. Meanwhile, renewable energy, we're trying to get more granular in our understanding of the potential economic benefits of renewable energy. We know the environmental benefits, but we're really trying to get granular on what are the economic benefits to moving toward clean energy and energy efficiency. So fracking has created a boom in oil production. Fracking has also created a boom in natural gas production. So everyone understands that what fracking is. It also comes along with the technological advance of a very long, like miles-long horizontal drill. This production boom shows no sign of ending. And it's both, sometimes you hear the word fracking, you might hear shale revolution, you might hear tight oil, sometimes you hear different wording, but it all means that there has been this big, largely impenetrable piece of rock called shale, and they inject something into that and produce either natural gas or oil. So sometimes they'll say unconventional production, tight oil, or shale. Here in West Virginia, you can see that the withdrawals of natural gas from shale resources have increased dramatically in the last decade. What I'd like to just point out is that the amount of oil and natural gas in this country has gone from a very small percentage 10 years ago, 16 and 12%, gas on the left, oil on the right, to 70 and 68%, or whatever that number is on the right. So most of the natural gas and most of the oil that we're producing in the United States is now from fracking. It has become an essential way for our country to get oil and gas out of the ground. So that's probably no surprise. Is anyone surprised by that news? You're all here, so you're aware of that, right? But I bet, because this is the world that I live in, is most people are not aware that fracking has been a financial bust. There have been huge numbers of bankruptcies. The cash flow has been negative for all 9 years that fracking has gone on in this country, including every quarter since the beginning of 2016. We follow 30 fracking-focused companies all over the United States. Some are fracking oil, some are fracking natural gas, some are in the Permian, some are in Marcellus. So we follow this group, and we've been following them every quarter, and they've been cash flow negative. Investors have gotten increasingly impatient because they have been putting all of this money into this sector, this fracking sector, but it has not produced financially positive results yet. And investors are starting to change their narrative about this being the next big money-making scheme. So first, the bankruptcies. 160 billion plus in bankruptcies just in 3 years. These are bankruptcy filings. Now, as you all know, with bankruptcy, sometimes the creditors get some of their money, but the equity, the people who bought stock in those companies, are generally wiped out. That's a lot of money. And that cash flow was negative, okay? So as I mentioned, we look at this every single quarter. And in Q3, for example, they continued their 9-year losing streak. And then at the end of the year, people said, well, gosh, in this fourth quarter of 2018, oil prices were higher. Maybe they turned cash flow positive, because that's what they always say. These exploration and production companies, these fracking companies say, we're about to turn the corner. We're going to be cash flow positive. And what we've discovered is they are very optimistic about this idea, but they haven't done it yet. So they dipped another $8 billion into their reserves in 2018 to fund capital expenditures and their operational expenses. So this isn't just our survey of the 30 companies we've been following for a number of years. The Wall Street Journal has a separate group, a lot of overlap with ours, and they said that the companies have had a $280 billion negative cash flow. Ours show that it's 200 billion, so it depends on how you define that universe, but this is an industry that sucks in a lot of capital, takes in a lot of money, and has not yet produced positive cash flow. So you wouldn't run a business this way yourself. And if your child wanted to do a lemonade stand like this, you'd let them go for a few weeks, but you wouldn't let them go summer after summer. When they're 4, you might say, okay, I lose a little bit of money, but this has been going on for 9 years. So here, these are the annual numbers here, starting in 2010, and if it's red, it's negative, so 20 billion, 19 billion, every year. Now, granted, it's now only 7 billion that they lost last year in terms of cash flow, but if you add all these together, you're up at the 200 billion amount. And looked at a different way, quarter by quarter, it's not even in one quarter that they became cash flow positive. So you think, how does this industry keep surviving? The financials in this industry are just terrible. So one of the things is, who here has studied accounting? And you survived, right? Are we traumatized by this? But there is something in the United States financial accounting standards which explains how this happens. And I'm not going to go into too much detail because you probably don't need it for purposes of this. But has everybody heard of a profit and loss statement? also known as an income statement. Okay, so all of your investments are not on the profit and loss statement. They're on a different statement, a cash flow statement. So what happens is all of these companies are putting huge amounts of capital expenditures which don't appear on a profit and loss statement. So the question is, why have investors not looked at a cash flow statement to see how badly this industry is behaving? And let's remember, investors make a lot of mistakes. How many coal companies went bankrupt? And looking at the financial crisis, Lehman Brothers and Bear Stearns had high stock prices only weeks before they declared bankruptcy. So just because investors are putting money toward an industry, a sector, or an individual company, it does not mean that these are successful, proven business models. So what I'd like to just point out with this industry is that they can appear profitable because their revenues would exceed their expenses, but that is ignoring the ongoing amount of capital expenditures needed in this industry. So they keep needing to get more wells, and the wells don't produce quite as much as they thought they would. Or they have these things now called the parent wells, and then all the child wells. Are you familiar with this? And they keep misjudging how much the child wells are taking away from the parent wells. It's still a new industry, and they are not yet able to forecast very well, which affects their bottom line. So what I'd like to do is just talk about some of the things they need to spend their money on. And I'm very happy I'm going to give my presentation to Leatra, and if any of you would like it, to go deeper into capital expenditures versus depreciation when you have nothing better to do on a Friday night, I welcome that. But remember that the frackers need cash for acquiring mineral rights, hiring workers, renting drilling rigs, contract with oil service providers, and they spend money on fracking sand, chemicals, well casings, piping equipment, cement, and supplies. And that's just the beginning. So we separate the investments that they make into capital expenditures from their ongoing expenses. So here you've got another image of how, when you separate all of your investments and don't count them against the amount of cash you're bringing in, how you remain cash flow negative. So you can see all of these companies here are cash flow negative on this side right here. This means they're losing, they put more money out quarter after quarter than they bring in from oil and gas. And you can see most of them are there are many more that are cash flow negative. The cash flow positive are the Exxon, Chevron, BP, Shell. These are global oil and gas companies. Fracking represents only a small portion of their business, although a growing portion of their business. But the ones over here are, for the most part, fracking-focused companies. That's their primary exploration and production, we call it. A couple of them have turned cash flow positive, but only very recently, after 7 years of losing money. Okay, so what I'd like to do is, and again, I will be happy to share these, but I'd like to talk about how the narrative is starting to change, because I think this is something important to be a bit hopeful about, because at first it was all about the production boom, the technological advances. Now the United States is producing so much oil and gas. And now they're starting to say, yes, they might be producing a lot, but they're spending so much to do this. Is this good business? And it's very important, because when Wall Street starts pulling back its money, it can slow down an industry because there's not enough cash coming in from their ongoing operations to keep going. What I'd like to also talk about is the economic development in fracking has been grossly overstated. We've done a study at IEEFA, the organization I'm with, on the economic development promises that were made. So they do a lot of projections. Fracking will produce this many jobs, and they've consistently been overly optimistic with these economic projections. The growth in employment, we did a deep dive into this, and what we discovered, probably no surprise to those of you who live in this area, is that for the most part, these are temporary construction jobs. And 40% of the pipeline jobs are done by workers from out of state. So it's not even that they're giving jobs to people who live in state. And the jobs in drilling and related activities actually have declined during this time period, from 2008 to 2017. The other issue is that there's a glut now of natural gas. There's too much natural gas, and you can see that in Texas, in the Permian Basin, they have to pay people to take the natural gas away, or else they flare it. So they're in search of oil in the Permian Basin because oil they feel is more profitable. So the natural gas almost gets in the way, and they literally just burn it off or pay someone to take it away. Obviously not what they're doing here in Marcellus. So the other idea is that the price has come down. Right now it's about 2.6, the Henry Hub. It was much higher, up over 6. If you go back 10, 15 years, there were times it was up close to 15. But now it's so low, it has had the effect of accelerating the economic decline of coal. Coal is no longer the cheapest energy source. Natural gas, coal at one point was 50% of the US power grid. It's now less than 33%. Natural gas is much cheaper. The other idea is that the economic development of fracking promised a lot of tax revenue increases. So here we see this production boom, but the tax revenues going to local townships has not kept pace with that. It's completely been much lower than the initial expectations and the initial forecasts. So we know that fracking, production boom, financial bust, they overpromised the economic benefits to local states and local communities, and they have underdelivered. So just going with Maliatra's theme of visioning what is an alternative. Is this the only alternative available to us from a financial standpoint? I know you're all going to talk about clean energy from an environmental standpoint and a job creation, but I'd like to mention from that standpoint, there is an alternative. So tax revenues and job creation, I'm going to just highlight 2 case studies, and I'll close with that. And one is wind and one is solar. So counties have seen major tangible benefits from taxes paid by renewable developers. New revenue streams have boosted government services and fostered indirect job creation. So some of these semi-permanent jobs, again, very similar to fracking, are construction, maintenance, equipment rentals. But the indirect jobs, when you've got this ongoing revenue stream from solar development or wind, is that you've got a tax revenue base that is ongoing and can have impacts on school districts with ongoing funding from the tax base, food and beverage business, city government staffing, and real estate rentals. So we've discovered this in the 2 counties that we've done a deep dive on. Revenues from wind power have provided funding for Paulding County public services without burdening taxpayers. So they were able to beef up what they're paying some of their public service officials without having to raise anybody's taxes. With Paulding County, they were also able to increase their bond rating. So for those of you who know with municipal bonds, if you've got an ongoing revenue stream, your county is considered financially more healthy and you pay lower interest rates. So in Paulding County, Ohio, the school district was able to improve their student-teacher ratio, something that every parent is concerned about. Like when you take your child to school and there are like 30 kids in the class and you think, oh gosh, of course you'd much rather have it be much lower. So they were really able to measure that specific benefit. Health benefits packages for school employees, quality of sports facilities. So this is what the money was actually used for that came in from a wind developer in Paulding County. So they were able to lower property taxes and improve school districts. As I mentioned, they increased the Moody's bond rating from single A1 to double A3. That's pretty big in the world of bond ratings to get into a double A. That means the county pays much less when it raises money. And this is because they had a long-term steady stream of revenue coming from a wind farm. In North Carolina, they built a solar, and they were able to diversify land use and reduce environmental risks. And one of the farmers that we talked to there was still able to farm with land, the animals that were grazing the land. So they were still able to keep their agricultural farm intact, but they were also able to have solar. So it didn't disrupt anything under the underlying economy there. Plus, it's probably a lot better in North Carolina than the 3,000 hog farms they've got in North Carolina, which is 14% of the hogs in the US. And it's not necessarily regulated by the environmental folks as it probably should be, the EPA. They just don't have enough manpower. And they were able, in this North Carolina, to put $2.5 billion directly to the state economy. North Carolina, believe it or not, is an explosion right now of solar going on in North Carolina. There's less pushback from local people like you at the grassroots level, to having a solar farm put into your neighborhood than if somebody says, would you mind if we put a big hog farm? Because everybody knows what's going to happen there. So, any questions? Thank you all.